The markets do not move in a random fashion. The advocates of technical analysis believe that the market moves in repeatable patterns. And this is a fact. The only way to make money in trading is by spotting these patterns and predicting the next market move. So, in this video, I will be sharing 2 chart patterns that you can master and apply it in your trading to achieve consistent profits. But before we start, be sure to hit that like button and subscribe to our channel so that you don't miss on any of our new videos. With that being said, let's get into today's video. So, chart patterns are basic price patterns that widely appear on almost every asset from time to time. There are a lot of profitable traders that solely focus on chart patterns for their trading decisions. Chart patterns as such are a wide subject. Just like indicators, there are thousands of chart patterns. Some occur often than the others. Some are more powerful than the others. My goal with this video is to elaborate and explain some of the most powerful patterns that I have used in my trading and have found them helpful. We will be discussing 2 patterns in this video. Number 1. Flag pattern. Number 2. Wedge pattern. Let us begin with the flag pattern. The flag pattern occurs when the price starts to consolidate after experiencing a strong surge in price. It is a trend continuation pattern. The name flag pattern comes from its close resemblance to a flagpole. The flag pattern is just a form of a pullback. When the pullback starts to consolidate, a flag pattern will be formed. A good flag pattern will occur after a strong trending move. For instance, here we see that the price made a strong up move. Then the market started to consolidate for a few candles. The consolidation was not flat. It was a downward sloping consolidation. So, here we have successfully discovered a flag pattern. Now, prior to this consolidation, the market made a strong up move. Hence, we expect that market to resume the up move after this flag pattern. In other words, we are expecting a bullish breakout. So, the breakout happens here. Here we see a bog green candle that breaks above the upper boundary of the flag pattern. If you look on the volume chart, we see that the volume on the breakout candle is greater than the previous candles. Therefore, the breakout is a strong one. So, aggressive traders can enter on the close of this candle. A more conservative approach here would be to wait for a retest. So here we see that after the breakout, the price retests the upper boundary of the pattern, and it quickly reverses, creating a strong pin bar candle with a big downside wick. So, the retest was also successful. Conservative traders can enter on the close of this candle. In this pattern, the size of the flagpole was 78 pips. Therefore, we can target at least 78 pips at our entry. This was a bullish flag pattern. Now, let's look at a bearish flag pattern. Here we see that the market made a strong down move here. Then, the price started to consolidate for a few candles. So we mark the upper and lower boundaries of the consolidation area. We discover a flag pattern here. Now, since this is a trend continuation pattern, we expect the price to resume the downtrend. Therefore, we want to see a breakout of the lower boundary of the pattern. The breakout happens on this candle. So we look at the volume to confirm the breakout. We can see that the volume on the breakout candle was greater than the usual. Hence, the breakout has been supported by the volume. So, we can enter on the close of this candle. Now, if you are a conservative trader, you might have waited for a retest of the low boundary. But the retest never happened. Therefore, you missed this trading opportunity. And that is the price you have to pay for being conservative. If missing an opportunity doesn't bother you too much, then you can successfully take up the conservative approach towards trading. But if you want to be more aggressive, then that is also up to you. Now, let's look at the wedge pattern. By definition, a wedge pattern is formed by creating two converging lines that connect the highs and lows of the price respectively. The main characteristic of the wedge pattern is that the distance between the upper and lower boundary keeps on decreasing as new candles are formed. Unlike the flag pattern, the wedge pattern indicates a trend reversal. And let me tell you that wedge patterns are one of the most successful ways of identifying a reversal. So if the wedge pattern is rising, we expect a downtrend occur. And if the wedge is falling, we expect an uptrend. Look at this chart. Here we see that the market was in an uptrend. We create two lines by connecting the highs and the lows of the price. We notice that there is a strong wedge pattern developing. Since it is a rising wedge pattern, we expect the market to start a downtrend after the breakout of this pattern. So we wait for the market to break the lower boundary of the pattern. The breakout happens on this candle. So, we look at the volume for confirmation. We can clearly see that the volume on the breakout candle was way more than the average volume. Hence, we can enter on the close of this candle. Conservative traders will enter on this candle as the price faces rejection after successfully retesting the lower boundary. In this scenario, the conservative traders entered at a better price than the aggressive traders. For sell trades, we can place our targets at the lowest point of the pattern. As you can see, the price gave a sharp sell-off after our entry. This was a rising wedge pattern. Now let's look at a falling wedge pattern. Here we see that the price created this strong down move. So plot two lines by connecting the highs and the lows of the price respectively. As you can see, we see a downward sloping wedge pattern develop on the chart. Since it is a falling wedge pattern, we expect the price to break the upper boundary and start an uptrend. So we wait for the breakout. The breakout happens on this candle, and we look at the volume for confirmation. When the price was between the wedge, we see that the volume dried out. But as we approached the breakout, there was a gradual rise in the volume. The breakout candle has a larger volume than the prior candles. Therefore, the volume does confirm the breakout. So we enter at the close of this candle. And as you can see, the market rallied after our entry. That brings us to the end of this video. In conclusion, I would like to say that both of these patterns are very powerful if you can draw them correctly. If you can practice plotting these patterns for the next 30 days, you will master them. Then, it will just be about finding opportunities and trading them. If you like this video, then be sure to subscribe to our channel so that you don't miss on any of our new videos. See you soon.